All right, so I'll look at this question for shoe black. All right, we have the information given here, as we can see. All right, we've got additional information here which says that our closing inventory is 1,660,000. 1,660,000. Trade balances totaling 6,000 are to be written off. So what this means basically is that the people who are owing us, all right, or the total amount that were being owed by our debtors, we're going to remove a 6,000 from there. All right, we're going to remove a 6,000. So when you go to your trade receivables, I just can scroll here. Trade receivables, this is 810,000. So we're going to deduct a 6,000 from this amount of the trade receivables. And then, since we have written this off, this is going to be like a loss to us, and a loss is treated like an expense. So we're going to see this 6,000 in our profit or loss statement, right? Then they've also told us that the allowance for doubtful debts has increased to 30,000, right? It has increased to 30,000. So this increase in the allowance for doubtful debts, right? Again, allowance for doubtful debts, this is the amount of money which we expect not to be paid back, all right, from people who are owing us, all right? So it has increased to 30,000. So this increase of 30,000, all right, is going to be added also as our expenses in our profit or loss statement, all right? Right, salaries and wages owing 190,000. This is an accrual. We add it to the amount of the salaries and wages. We've got this 70,000, which is paid in advance. This is a prepayment. It's an asset. We're going to subtract it from our salaries and wages. Okay, distribution expenses of 60,000 were prepaid. Again, this is a prepayment, so we are going to deduct it from the distribution expenses. And then it says 130,000 was not paid. So this is an accrual. All right. And an accrual is a liability. Got to mention that an accrual is a liability. All right. Interest of 50,000 is owing. This is another accrual which will be added. Right. Then in January 2018, the business received invoices for credit. Hello? In January 2018, the business received invoices for credit purchases totaling 18,000 for goods delivered before 31st December. So also this is an accrual, and we're going to add it to our purchases expense. Okay, so that this 18,000, we'll add it to our purchases expense, which is 800. This is 8.1 million. 8,100,000. Yes, 8 million. 8 million and 100,000. So don't forget these zeros on top. These zeros, so that we can don't get confused with the numbers. Okay, so I'll start with first the trading account. Purpose of the trading account is to find the gross profit. All right, the purpose of the trading account is to find the gross profit. Okay, we're going to go to this information here. Okay, let me just bring this information next to the trading account. Okay, we go to sales first to find our figure for sales. I think sales was here. Sales, it says 13,600,000. Okay, 13,600,000, which is here. Okay, we look for our return inwards. Return inwards, this is when customers bring back goods to us, right? When customers bring back goods to us, that is called a return inwards. All right, so we deduct that amount from our sales. Okay, so as we can see here, return inwards is 400,000. Just zoom in a bit. It's 400,000. Where is it again? Yeah, return inwards 400,000. So you deduct 10 inwards from sales, you get 13.2 million, right? Next, we're now going to focus on our cost of sales. Basically, this is just the cost of doing business. All right, so we start with our opening inventory. This is the inventory from last year, which has come into this year. Okay, the goods that were not sold last year, yes, they have come into this year. So we call that as our opening inventory. So we see on our trial balance, let's see where is open. Inventory 1st January, it's 1,530,000. Yes, 1,530,000. Put it here. All right. Purchases, all right. Purchases, it's 8,100,000. And then we also have these credit purchases, which which forgot to put. All right, these are the credit purchases which we forgot to put for the previous year. So I'm going to say 18,000 plus 8.1 million. We're going to get 8,118,000. All right. Then we have our carriage inwards. All right. Whenever you buy goods and if your supplier is transporting those goods to you, that is carriage inwards. Okay. You always add it to your purchases. So carriage inwards 700,000. Add it to the purchases. 8,118,000 plus 700,000, you get 8,818,000. Okay. Then we can see we've got our return outwards. Return outwards, these are the goods you return back to your supplier. Okay, these are the goods you return back to your supplier. So you're going to deduct it from the purchases. So 8,818,000. You subtract 150,000 from that, we're going to get 8,668,000. Right? And then this amount, we're going to add it with the amount for the opening inventory. This 1,530,000, add it with our 8,668,000. All right, you're going to get 10,198,000. Okay, 10,198,000. All right, and you call this the cost of goods available for sale. All right, cost of goods available for sale. Total cost of goods available for sale. And then we're going to subtract our closing inventory, which is 1,660,000. Right, so you say 10,198,000 minus 1,660,000. We're going to get 8,538,000. All right. Then your gross profit is your sales minus your cost of sales. This 8,538,000, that is our cost of sales. So sales minus cost of sales, that gives you your gross profit. Let me just highlight this. So 13.2 million subtract by 8,538,000, you get 4,662,000.